Hey guys, what is up? Welcome back to my channel. Have you heard people saying that the stock market always go up over a period of time? And there's this saying that if it sounds too good to be true, it probably is. But for this case, this is probably one of the very few cases where it is true. If you're feeling a bit skeptical right now, it's perfectly normal. Because in today's video, I'll be sharing with you the 3 reasons on why does the stock market always go up. In this video, when I'm talking about the stock market, I'm generally referring to one of these 3 indexes, either the S&P 500, the Dow Jones, or the Nasdaq. The S&P 500, Dow Jones, and the Nasdaq are 3 of the most widely used indexes in the US. These 3 indexes cover a wide range of companies and therefore give a good representation of the US stock market as a whole. So when we are talking about the stock market in this video, we are generally referring to the S&P 500, Dow Jones, and the Nasdaq. The S&P 500 includes the 500 top companies in the US, and these companies are selected based on their market capitalization, liquidity, public float, sector capitalization, financial viability, and trading history. These are some of the criteria that companies are judged on before they are included in the S&P 500. The Dow Jones include 30 of the largest and most influential companies in the US. The Dow Jones typically include blue chip companies which pays dividends. And while they might not necessarily give us a good representation of the broader market, they however give us a good idea of what's going on with the more established companies in the US. The Nasdaq on the other hand is heavily tech weighted. So a huge portion of the Nasdaq is weighted towards tech stocks. And unlike the S&P 500 and Dow Jones, the Nasdaq also includes companies with smaller market capitalization, which tends to be a bit more speculative in nature. So that is a quick overview of the 3 indexes which give us a good representation of the US stock market as a whole. So back to the question, does the stock market always go up over time? One famous investor certainly thinks so. Warren Buffett, one of the most successful investors, has this to say about investing in the stock market. He mentions that for most people, the best thing to do is to own the S&P 500 index fund. In fact, he believed that the US stock market or the S&P 500 index will always go up over time, that he instructed the trustee who will be in charge of his estate to invest 90% of his money into index funds for his widow. Let's take a look at the price charts for these 3 indexes and see how they have fared over a period of time. So if you take a look from the left to the right side of the chart, the S&P 500 have increased over a period of time. You might have the worst luck and invested at the worst possible time over here. And while it might have taken you some time for you to break even at this point over here, but you'll see that over time the stock market still rise and you'll still make some money. Or say you invested at the peak of the dot-com bubble over here, you can also see that given time, you still make money in the long run. This is the price chart for the Dow Jones, and you'll see that from left to right, prices also increase over time. And for this example, say you invested at the height of the housing bubble, the stock market declined immediately after. However, over time, the stock market managed to rise all the way back up and make newer highs. This is the price chart for the Nasdaq, and this was the height of the dot-com bubble. Prices rose up parabolically during the lead up to the dot-com bubble. And at this point over here at the height of the bubble, say you invested in the Nasdaq, you would have faced substantial loss on your capital during this period of time. However, if you manage to hold on to the Nasdaq and have a longer term outlook, you'll see that over time, the Nasdaq managed to claw back its losses and make newer highs. So from the price charts of these 3 indexes, the S&P 500, Dow Jones, and the Nasdaq, you saw that these indexes and the stock market as a whole always rise up over time. Sure, there will be periods where the stock market declines, such as in the dot-com bubble and during the housing crisis. However, over a longer time frame, the stock market always rises. So why does the stock market always rises over time? There are 3 main reasons. The first is that these indexes, which give a good representation of the US stock market as a whole, tracks the largest and best performing companies. For example, the S&P 500 only includes the 500 largest companies in the US. Only the biggest and best performing companies are included in this index. And companies that are not doing well will be excluded from this index. So to be included in this index, companies have to be big and up and coming. And even though these companies may have been previously included in the S&P 500, if these companies do not continue to perform, then they will be replaced by bigger and better performing companies. So in this way, the indexes only include the largest and best performing companies. Yahoo, which used to be the #1 search engine, was one of the up and coming companies to watch out for, and they were included in the S&P 500 back in 1999. However, over time they lost their position as the #1 search engine to Google, and they have been on a steady decline ever since. And in 2017, Yahoo was removed from the S&P 500. So the S&P 500 is continuously updated to include only the largest and best performing companies. And companies such as Yahoo, which may have been previously included in the S&P 500, these companies will be then replaced by newer and better performing companies in the index. These are some of the more well-known companies that have joined the S&P 500. So Facebook, the social media giant, was included in the S&P 500 back in 2013. Google, which used to be Yahoo's competitor, joined the S&P 500 back in 2006. MasterCard joined the S&P 500 in 2008. and Amazon joined the S&P 500 back in 2005. These are some examples of companies being included in the S&P 500. Next, we'll take a look at some examples in which companies got replaced in the S&P 500. In this example, you see that Urban Outfitters, Frontier Communications, and First Solar was removed and replaced in the S&P 500. And Macy's, which used to be one of the biggest clothing retailer in the US, was removed from the S&P 500 in early 2020. This is how the S&P 500 have evolved over time. Back then in 2008, the top 10 S&P 500 companies were ExxonMobil, Walmart, P&G, Microsoft, AT&T, Johnson & Johnson, General Electric, Chevron, Pfizer, and JP Morgan. And in 2009, the top 10 companies were ExxonMobil, Microsoft, Walmart, Google, Apple, Johnson & Johnson, P&G, IBM, AT&T, and JP Morgan. And in 2010, the top 10 companies were ExxonMobil, Apple, Microsoft, Berkshire Hathaway, General Electric, Walmart, Google, Chevron, IBM, and P&G. While in 2013, it was Apple, ExxonMobil, Google, Microsoft, General Electric, Johnson & Johnson, Chevron, P&G, JP Morgan, and Wells Fargo. So the S&P 500 is updated continuously. Now, let's see why by tracking only the largest and best performing companies, these indexes or the stock market as a whole will generally increase in price over time. We know that only the largest companies are included in these indexes. And by only including these largest and best performing companies, the stock price of these companies will increase over time. If you have liked this video so far, you can cause the number of likes in this video to rise by liking this video. So make sure you smash that like button. Alright, let's get back to the video. The price of the S&P 500 is computed from the total of these companies, and that is why the stock market always go up. So that's the first reason, because the stock market or these indexes only tracks the largest and best performing companies. The second reason why the stock market always go up over time is population growth. The UN projected back in 2017 that the population of 7.6 billion then was expected to reach 8.6 billion in 2030 and 9.8 billion in 2050. But it's not just the increase in global population size. The increase in global population size also corresponds with the growth in the middle class, and the population of the global middle class is expected to grow to 4 billion by 2021 and reach 5.3 billion in 2030. And on top of all that, middle class spending is expected to grow from about 37 trillion in 2017 to 64 trillion by 2030, and that will account for about 1/3 of GDP growth. The growth in the global population, coupled with the growing size of the middle class, coupled with the increasing in spending by the middle class, will lead to an increase in demand for companies' goods and services. And when the demand for these companies' goods and services increases, this leads to increase in companies' revenues and profits. And when revenues and profits increase consistently for these companies, stock price of these companies will also increase. Because prices of these indexes are computed based on the prices of the companies that are included in the index, the increase in stock prices of these companies will also lead to an increase in the price of the indexes. And that is the second reason why the stock market always go up over time. The third reason why the stock market always go up is because of inflation. The definition for inflation is the rate at which the average price level of a basket of selected goods and services in an economy increases over a period of time. Inflation rate in the US has been positive for most of the time in the past 25 years. The only time where inflation rate has been below zero was around this period over here and this period over here. With inflation, there is an increase in the price level of goods and services. And when the price of goods and services increases, the revenues and profits that companies collect will increase. And when the revenues and profits of companies consistently increase over time, this will lead to an increase in stock price of these companies. And because these indexes tracks these companies, price of these indexes will also increase. So the three main reasons why the stock market always go up is because firstly, the stock market or these indexes tracks the largest and best performing companies. And because these companies will grow over time, the stock price of these companies will increase. And they will bring the prices of these indexes along with them. The second reason is because of population growth. The global population is expected to increase in the coming years, and there will also be an increase in the size of the middle class, and the spending of this middle class is expected to grow in the future. Therefore, there will be an increase in demand for goods and services of companies, and this will drive up the price of companies and their indexes. The third reason is because of inflation. With inflation, there's an increase in price levels of goods and services. Companies will collect higher revenues and profits, which will drive up the price of the stock and subsequently the price of the indexes. So that is why the stock market always go up over time. If you have learned something from this video, make sure you subscribe to this channel, because each week I release one new video about investing, trading, and the stock market, and you don't want to miss out on any of these videos. I'll see you in those other videos. To your financial success.